Welcome to the Elevate Market Chat. This episode was recorded September 26. In this episode, Shane and I discussed the latest Fed meeting and the decision to lower the Fed fund futures by 50 basis points. We're looking at new all-time highs in the S&P 500 and other equity indexes. And then also with lower rates on treasuries, what are the alternatives to investing right now to earn a decent rate of return or look at the overall stock market as a potential investment? So we will get into all of that in this episode. Thanks for tuning in and be sure to like and subscribe.
Shane, how's it going?
Hey Kyle, I'm doing well today. How are you, man?
Doing good. I'm actually sitting on a rooftop or a ridge top right now. So if my audio is a little off, that's part of it. But, it is September 26th. And for me, that is kind of the tail end of archery season. And I'm holding a tag that took 24 years for me to get. So, apologies for any audio, but we really enjoy this call. And this is a testament to that. So how have you been?
I'm good, but for all the people who don't live in Colorado, I have two questions that they're probably like, what did he just say? So what does on top of a ridge line mean, and what is a tag?
So on top of a ridge line means that right now I'm just a high point on a mountain where I can see for miles and miles and, looking for animals. And then the tag is a special license or, a permit that allows me to actually go out and hunt. And this is a special unit where there are only 13 of those tags that are even given out for this season. So,
in the state of Colorado?
Like myself, in the state of Colorado.
Yeah.
So for somebody like myself, it took 24 years of just waiting until I had accumulated enough points, much like somebody might accumulate some wealth to, buy a house or something else. And I'm trying to make the most of that opportunity.
So just because it's bow hunting season, excuse me, in Colorado doesn't mean you can just take your bow and go out and shoot any elk you want. Is that right?
So in this one, right, so yeah, unit specific. So I'm in a region here where I'm permitted to hunt. And then it is, you're trying to find the elk of your dreams when you wait that long. So.
Yeah, that's awesome. Well, you're doing that, and I am riding out a hurricane that's about 100 miles offshore here in Florida. So Hurricane Helene, I think, is what they're calling it. And so far, things are pretty tame here. We got a little bit of wind and a little bit of rain, but the sun was just out a bit ago, just in between some of the bands. And looks like the worst is maybe still to come, but looks like it should be a category 3 by the time it gets near my house, and we'll get some hurricane winds, but I don't expect it to be too bad. This is just part of the deal when you live in Florida. So here we are.
Yeah, well, hopefully nothing too major comes through, and then I'm on the opposite end of that where I am in the desert basically, and I have not seen a raindrop in a month, so a little different. But since the last time we met, I just thought I'd start off with, we did have that big Fed rate cut that everybody was just waiting on, and it was going to solve the world's problems, it seems. What's your takeaway from that? So they did cut it by 50 basis points. And
the jumbo rate cut.
Yes, that was on the higher end, wasn't it?
Yeah, we got the jumbo rate cut. I don't know why. I mean, yeah, the market seems to have just kind of pushed the Fed into cutting 50 basis points by placing bets in the futures market and also buying a lot of 2-year bonds, which pushes the rate down. So the 2-year yield was falling really hard leading into the Fed meeting, and so the Fed was they were behind the market and they needed to kind of play catch up. So I don't think they should have cut rates. I don't think that's really gonna be good for the people who are most heavily impacted by the rising cost of food and gas and just life in general. Ultimately, all else equal, a lower rate is going to lead to higher prices, right? And that means higher prices of lots of things. from food and gas to stocks and houses. So that relationship is I'm sure intact, as it's well established over lots and lots and lots of time. Cutting interest rates while the market is at a relative high is also very interesting. It just tells me that they're, number one, they got forced into doing this by the market, which had gotten ahead of them, and beyond that, it tells me that they're very concerned about the job market, because the Fed has this
And
dual mandate, which is to create price stability and maximum employment, and so unemployment must be very concerning to them, because prices still have not fallen down to their stated target of 2% inflation year over year. And if you look at the summary of economic projections that they put out quarterly, and they did put out in September, as a group, the Fed doesn't expect inflation to get to 2% until 2026. So basically, inflation is higher than they want it to be, but the employment situation is such that they've shifted their focus to that part of the mandate, and they're focused on making sure that there's the unemployment doesn't rise too quickly between now and I guess whenever they think inflation's going to go back to 2%. But look, you can't believe what
yeah,
these
and
people think anyway. They told you inflation was transitory, when it was going to 9%. They don't know. If anybody thinks that the Fed knows what inflation's going to be in 6 months or 8 months or in 2 years, all they need to do is go back and look at history, and they'll find out that they have no idea. I have no idea. None of us have any idea what inflation's going to be. But all else equal, a lower interest rate means inflation's going to go up.
yeah. And Shane, I just wanted to maybe dive a little deeper. What do you mean when you say the market pushed them into it?
Well, the Fed just doesn't like to surprise the market, right? So traders, we've talked about this before on this call. Traders could bet on what the Fed funds rate will be in the future. There's a futures contract, just like you can bet on what the price of gold will be in the future, or what the price of the S&P 500 will be in the future. These are futures contracts that are traded very actively. They're used for speculation. They're used for hedging. They're used for a lot of market functionality, right? And so there's a futures contract on Fed funds, and traders had basically bet that the rate would come down by they basically priced in a 85% chance of a 50 basis point rate cut, and a like a 15% chance of a 25 basis point rate cut, and that changed big time during the week leading up to the meeting and the decision and all that, even without any real economic data to support it. In fact, the data that came out in the week leading up to the decision it was actually better employment numbers than expected, which would lead you to think that the Fed should cut by less, if at all. And the futures market basically just totally ignored that incoming data on employment and continued to place their bets for a 50 basis point rate cut. And so that's what the market was expecting. And the Fed doesn't like to disappoint the stock market, because the futures market, because the stock market will react very poorly to it. So anyway, the futures market really pushed the Fed into making this decision. It kind of looks like the Fed is impotent and getting pushed around by traders, which is not really, a good look for a government agency that claims to be independent and apolitical. Um, I don't know. It reeks to me. Now, I'm not saying they did it because of the presidential election coming up, but you know, it's hard not to think about that and say, well, geez, maybe they don't want the certain person to win, and they'd rather see the current administration sort of remain there. And so I don't know. It's hard to get around this conversation without having that discussion. But if you ask the Federal Reserve, they will say that they don't even consider politics when they make these decisions. But I don't know.
And
They
I
don't
think
live
it's
under a rock.
partly what you're getting at there is that the market is going to position. So people that are managing money will put on all their trades, and essentially they are expecting that the Fed would do a certain rate cut, or they're expressing that opinion. So then if the Fed were to surprise them and go the other way, that really can wreak havoc on the markets, which the Fed does not want. They want to clearly be transparent and kind of guide expectations. Do I have that right?
Well, maybe. I don't know what they want to do. I think they're useless and the Fed ought to be abolished. So I don't really know what they want to do. I know what they tell you they want to do, but then they behave in ways that are contrary to that. So, um, you know, as Ronald Reagan said, some of the scariest words in the whole English language are like, "Hey, I'm from the government and I'm here to help." You should always
Mm-hmm.
be very afraid if that's what they tell you because they're probably not going to help very much. So I don't know. I don't know. I mean, it's it's just news, man. People like to follow it and talk about it. I don't really care that much what they do. They're going to do what they're going to do, and we're going to behave how we're going to behave based on what they do. And so I'm not gambling on what they're going to do, and I don't really care. I don't place bets on what the Fed might do next time they meet. I just don't care. My job is to react to it and make trades after the fact, not before the fact. I am not a futures trader. I'm not going to place a bet that they're going to do a 50 basis point cut and then be surprised when they don't do a 50 basis point cut and lose money on it. I don't know. That's not what we do. That's what some people do, but that's not what we do.
Right. So then coming out of this, we've now had this economic policy move. And when you talk about, well, then what's next? How do you kind of manage the money around that? You shared the slide with me that I think that came from Hedgeye, who is a service provider that helps kind of manage risk, and we work with them on some stuff here. And what was your takeaway, kind of reflecting on what they are saying about the market?
Yeah, I wouldn't even say that they are saying anything. This is just a basic framework, and this is our framework that we have adopted. I learned it from these guys, so I'll give credit where it's due to the Hedgeye team. They're very good macro analysts. But look, there's only four different types of market environment. It's basically a quadrant matrix that has inflation and GDP on it, and sometimes inflation is rising, and sometimes GDP. Sometimes inflation is rising, sometimes it's falling, and sometimes GDP is rising, and sometimes it's falling. Sometimes they're both rising together, and sometimes they're both falling together. Sometimes they're going in different directions. Um, so I won't get into trying to describe an entire slide that people can't see. But the point is that what we are now in is something that we would call quad three. Uh, and the market narrative here is that we're in a stagflationary environment where inflation is going to rise while GDP is falling. That leads to a kind of a neutral monetary policy. Um, right now they're obviously getting more dovish, right? They're cutting interest rates already, but eventually what they're going to do is hit the pause button and kind of leave rates alone and see what happens. And if the market does experience stagflation, which means inflation and lower GDP, we're going to have a problem because if they hike rates to try and fight the rising inflation, they're just going to put further strain on growth and GDP, and we'll be in a recession. So, yeah, who knows what will happen? But right now we're in a situation where inflation is probably going to rise because look, we came from a situation where GDP and inflation were both slowing, right? They were both slowing down in terms of rate of change. What that did was led to a dovish policy decision from the Fed where they cut by 50 basis points. Well, when the Fed cuts interest rates by any amount of basis points, let alone 50, they normally only cut by 25 basis points. So they did double what their normal movement is. Um, what that does is that sends the US dollar lower, right? The US dollars become worth less, which means things that are priced in US dollars, like food and gas and homes and lawnmowers and stocks and gold, all those things are going to cost more in terms of US dollars because the dollar is worth less. So that's where we are now. dollars going to go down. Things priced in dollars are going to go up. That is the definition of inflation. And look, inflation is not a bad thing. Inflation, well, I shouldn't say that. Inflation's not a bad thing for people who have a lot of assets because your assets will all go up in value, whether it's stocks or bonds or, well, maybe not bonds as much, but home prices and land and farms and gold coins and, all types of things will go up in price. So if you own things that go up in price, you're fine with inflation. Who it really hurts is people who don't own a home and people who don't own any rental properties and people who don't own any stocks. These people are just going to see prices increase, but they won't have any assets that increase along with it. So they're going backwards. Well, so it creates more income inequality, basically. The richest of the rich, right, are going to get richer under an inflationary policy, and the poor will get poorer in an inflationary policy. So it's not really, good overall. But if you have a lot of stocks, capital efficient stocks in particular that don't require a lot of ongoing investment or hiring or new factories, those stocks are going to do very well if inflation ticks back up, and I believe that's exactly what's going to happen due to the policy that the Fed has chosen to take. And if you have any questions about that, go back and read my my September market commentary that starts off with a quote, and I think it's just such a great quote. I don't want to butcher it. I'm going to try and look it up really quick here while I'm thinking about it. But ultimately, what it
Yeah, and I
says is
think
that inflation is a policy. It's a choice, and so it's not like it says the most important thing to remember is that inflation is not an act of God. That inflation is not a catastrophe of the elements or a disease that comes like the plague. Inflation is a policy. So this is a choice.
it is, and it's an interesting environment here where when I heard the news on the rate cut, and I've been out here kind of disconnected from all the news out there. A 50 basis point cut to me was interesting one in front of the election. That's one where you kind of start to wonder about politics, but I think more importantly is just wondering on the employment side, the lowest earners that are impacted by inflation the most, cutting by 50 basis points, it really makes you wonder, is the unemployment going to tick up that bad right now? And then also you're kind of pulling the brakes off inflation, which I think while that might be unpopular, that's definitely something that's going to kind of hurt those that are down in the bottom.
Yeah, well, it really makes you wonder. I mean, you remember how slow they were to start hiking rates. I mean, they told you inflation was transitory and it was just going to be COVID supply chain related. It would all go away in a couple of months, blah 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 blah. They told us that for months, quarters, They were very, very slow to start hiking rates to fight inflation. But the moment that we get to, we're not even at 5% unemployment yet, right? I mean, we're at it was like 4.4 or something. I mean, it's really historically, it's not a very high unemployment rate at all. And they're bringing out the big guns and already cutting by 50 basis points. And the market's already is pricing in another 75 basis points of cuts by the end of the year. Last I looked. So that there's only 2 meetings left for the rest of the year. So if the futures market is currently expecting them to cut by 75 basis points over the course of the next 2 meetings, that means at least one of those meetings they got to cut by 50 basis points again in order to get there. So who knows if they will? I mean, the futures market can move around and can change at a moment's notice. So by the time we get to the next meeting in November, maybe they're not pricing in any more rate cuts. But I don't know. The Fed governors have all been out there doing their interviews and doing their talking points, and it sounds to me like they're probably going to continue cutting. And the question you have to ask is why.
Mm-hmm.
Why would they be doing that if everything was so good? And the market just seems to not be asking that why question. The market just seems to be like, well, they're going to cut rates. Let's buy stocks. But in my last commentary, I put a chart in there that showed that just because the Fed's going to cut rates doesn't necessarily mean market's going to go up. The past few times they've cut rates, the market has dropped pretty substantially during each of those rate cut cycles, albeit not immediately. And it doesn't have to continue happening that way. If you go back a little bit further, you'll find out that, a rate, the beginning of a new rate cut cycle does not necessarily lead to 100% of the time the market's going to go down. So, don't go place any bets based on that. But I don't know. Well, we just react, right? We prepare for a wide range of outcomes, and we're ready. Today we're fully invested, so we're happy to see the market rising and our clients making a little bit of money. But we got our stops in place, and we're ready to pull the plug if things turn around.
Yeah, that has been good, and I think that's the big one is that trends can continue longer than one might imagine. And right now we are in an uptrend, so it's continuing that way. Yeah, I had a question come up, and it was for those who had money where they put it in short-term treasuries because they've been paying well. I mean, around 5%, not such a bad rate given the risk-free nature of treasuries. But now we're going into this rate cutting cycle, and that opportunity might not be there. How have you looked at that, or what options do you see for kind of an alternative to just trying to do that short-term investing where you get 5%?
Yeah, well, this is part of what I mean when I say it's, the policy decision is going to force prices up. So people are looking at that and saying, well, geez, it was easy to make 5% for the past year and a half. All I had to do was roll out of bed and buy some treasuries that mature in less than 12 months, and I'd be making 5%. Well, now that's not happening anymore. So people are going to look for places to put the money where they can make a little bit more, and that's going to lead people to buying more stocks, right? That's going to indirectly push stock prices even higher. So I don't know. I don't know that 5% is a good target. I think your target on what you can make in a risk-free environment or in a risk-free investment needs to be relative to what's available in the treasury market. So money market rates are all going to come down. High interest savings account rates are all going to come down. That's going to happen. And so in our short-term treasury strategy, our goal is just to beat what people could get in a high interest savings account at their bank. And we'll continue to do that, right? So if the bank was paying 4% or 4.5%, they're going to be down to 3 or 3.5%, and the treasuries are going to be down, to 3.5 or 4%. And so we'll probably still be able to earn a little bit of a spread higher than what you could otherwise get in a risk-free investment. The only other way to get more or continue to let's say that the 1 year U.S. Treasury rate goes to, I don't know, let's say it goes all the way down to 3%, right? Well, that's the new risk-free rate, right? The new risk-free rate at 1 year is now 3%. So if you want to keep making 5%, you have to be willing to take some risk. It's that simple. So there is no way to get something above the risk-free rate without taking risk. Those are arbitrage things that don't come up very often, and you can't even really call it arbitrage because in order to be a true arbitrage, you have to take no risk and not use any of your own money. So that's that's a harder measure to meet. So anyway, if you need to make 5% and the risk-free rate is 5%, well then cool. You can meet your objective without taking any risk. But if you need to make 5% and the risk-free rate's only 3%, well, then you need to be willing to take some amount of risk in order to achieve that extra 2% return. And so the question then becomes, okay, what's the least risky way to get that done? And you mentioned, so I don't know if you mentioned it when we were just talking or if it was before we jumped on this call, but selling put options is generally a great way, but you need some volatility. So you can sell put options on things that you would like to buy. I don't think we have time to get into how that really works, but basically you can get paid to name your price. So you want to own Disney at $50 a share, but it currently trades at $90 a share. Well, you can sell a put option that obligates you to buy shares of Disney at $50. At some point, in a specific time frame. And if it never drops to $50, then you'll never be, you never have the chance to buy it at $50. But if it does drop to below 50, then you'll be forced to buy those shares at 50. So you better have at least $5,000 in your account to pay for that, if that were to come to pass. So, you can get paid a pretty nice return to agree to do things that you would happily do for free, and selling cash secured put options is what I would, if I were looking into this, if I was a listener and I was like, what is he talking about? That's what I would go type into Google or Perplexity AI. I would say, what is a cash secured put sale? And that'll probably put you on the right track to learn a lot more about it.
Yeah. And I think the big one to point out, Shane, is just what you were highlighting with risk-free and then the alternative. This is an alternative that is not risk-free, so there's some risk. And the big things to pay attention to is if volatility is high, that option is worth more. You get compensated more for your risk, and the risk being that if volatility is high, there's a higher chance it does hit $50, and now you have to buy it. But also, you need to decide ahead of time, okay, if you buy it at 50, at what point might you say this thing can go to zero? Because if that stock did go to zero and you kept buying it, you could lose a lot of money that way. So
that's the real risk too, is that before, that's not that it just dropped. Hey, you sold the put option at 50. What if it drops to 25 and now you got to pay 50 for something that's only trading at 25? You're down 50% immediately right out of the gate. So, could that happen to a stock like Disney? Sure. I mean, things happen. Somebody dies on a ride, or um, some type of hack happen. I don't. There's all types of unforeseen things that, black swan events they call them. I have no idea what could happen, but that's the real risk. Is you say, hey, I'm willing to buy. If Disney's currently trading at 90, if it were at 50, I'd buy it for sure. It's easily worth that. Well, it could go lower, right? So maybe it drops to 40, maybe it drops to 30, maybe it drops to 25, and you're forced to buy it at $50 a share still. So you spent $5,000 on 100 shares of Disney that are now only worth $2,500 immediately, and now you're stuck in that trade. Maybe for a long time, and maybe it never recovers. And like you said, Kyle, maybe it goes to zero from there. So you can lose that money. There is risk. Now, how big is that risk? I think the risk of Disney going to $25 is pretty low. And I'm here to tell you right now that if it did go to $25, I would be buying it hand over fist. Absent like somebody having dropped a nuclear bomb on every single one of their theme parks, which, hey, can't rule that out either at this day and age. People are crazy.
Right. So certainly some options out there. I think the biggest thing is just always understanding what the actual risks are, because everything other than treasuries, you have a risk embedded in it. So if
I'll tell you one thing.
Understand that.
Sorry, I didn't mean to interrupt you. One thing I would not do is I would not go out too far on the curve as far as it relates to duration. So, if you're getting 5% loaning the government money for 1 year at a time, maybe you could go out to 2 or 3 or 4 years and get the same 5%. Well, if you go out to 5 years or 10 years or 20 years, you go way out on that duration curve trying to increase the yield, because the yield curve is now normalizing, right? So the longer term interest rates are higher than the shorter term interest rates, which is economic standard, right? Without the Fed and without the manipulation of monetary policy, that's how it would always be, right? There's no logical reason that loaning the government money for 1 year should pay a higher rate of return than loaning the government money for 10 years. The only reason that stuff happens is because of manipulation from the government and the Fed and so on. So, what I wouldn't do though is I would not loan the government money for any longer than a year. I mean, maybe 2 years or 3 years, but I said you get out to 5 and 10 years, and you look at the 35 trillion that we're in debt and the roughly 10 trillion a year that needs to be rolled over because the Treasury keeps borrowing in, like 1 year at a time. They keep borrowing short-term money that they have to keep rolling over and paying back at whatever current interest rates are. By the way, not to get too carried away, we probably got to get wrapped up here, but the amount of the amount of debt that the Treasury needs to refinance in the next year or two probably also pushed the Fed into cutting rates, because we just paid as a nation over $1 trillion in annual interest. We're running almost a $2 trillion annual deficit. So like half of our deficit spending every year is going to interest. The only way to bring that down is to bring rates down. If you do that, inflation's going to go up. I mean, all this stuff is interconnected, right? So I think there's a lot of forces at play pushing the Fed to cut rates, even though it's probably not the best decision for the economy and inflation, certainly. But look, I think interest rates are ultimately going to go higher. And since the Fed has cut interest rates, they have actually risen. The short end of the curve is going down a little bit, or at least staying flat, not falling too much. But the 5-year rates are going up, the 10-year rates are going up, 20-year rates are going up, and they've just gone up relentlessly since the Fed cut rates. And so what that tells you is that, you know, the market doesn't believe that the government can actually pay these loans back on time and in full with uninflated dollars. Otherwise, the rates wouldn't go up that much. And if you loan somebody money for 20 years and the interest rates go up a lot over the course of that 20 years, you're going to be losing a lot of ground to inflation. So I'm going to put out. Actually, I'm going to talk about this a bunch in my upcoming commentary. I'm going to put some charts in there for the debt maturity schedule of the United States, and then how much long dated how many long dated bonds U.S. banks have on their books with unrealized losses. Like we're talking $700 billion of unrealized losses because of the rise in interest rates. And these are on 10, 20-year loans to the government. And these banks are just getting smoked.
And that ties back to some of those bankruptcies that we saw earlier too. Is that right?
Yeah, in 2023. It's directly what happened in 2023 when we had the biggest bank failures since the Great Financial Crisis. Can't remember all the names offhand, but First Republic failed, and Silvergate Bank got shut down. Silicon Valley Bank failed. There were others. Signature Bank New York was one. So yeah, I mean, that's all coming back around. That's all going to come back around.
Interesting. So a lot going on out there, but I think this policy move certainly will have a ripple effect, but it'll probably take a little time to feed through. So we'll see.
Yeah, look, the big takeaway that I would want to leave our listeners with today is that the economy is not in a good shape. The government is bankrupt. The U.S. is absolutely broke. It's a miracle that the U.S. dollar is still taken as a reserve currency all around the world. But it is. And because it is, this policy is going to lead to a rise in asset prices. So ultimately, there will be a recession. Who knows when it'll happen? When it happens, it'll be gnarly. But given this policy, what's going to happen is inflation is going to come roaring back. Now, that shouldn't scare you. That you should look at that as an opportunity. What you need to buy now, if inflation is going to continue, and if all this is going to play out the way that the Fed is handling it now, what you want to do is you want to buy capital efficient businesses that can raise their prices without having to invest a lot of money in new factories and new employees and new machinery and just all types of things like that. You want to own Hershey, and you want to own Coca-Cola, and you want to own technology companies as well that have a very high gross margin, and the profitable ones, though, probably not the unprofitable ones quite as much. So this is an opportunity for people with money to invest. It's not something to be afraid of. But if you want to keep up with the price increases that you're going to see at the grocery store and at the furniture store and everywhere else, you've got to get invested in assets that are going to go up more and faster than your costs, right? And that's how you're going to become wealthier during an environment such as this.
Interesting. So, well, Shane, thanks again for taking the time to get on a call with me and make it through the storm that you're in. So, wish you and your family well. That hopefully nothing too big comes through. And I think I'm going to get back out in the woods here. So,
All right, man. Well, bring
Great
us home an
chatting with you.
elk. I am looking forward to you sending me a steak or two or something like that.
I'm working on it. Certainly send some your way, and I know we've got some other members on the team here that could certainly use some elk jerky and all that. So,
all right, man. Good luck
we'll
out
see,
there. Thanks for your time, Kyle.
Thank you. You have a good one.
See ya. Bye.
Special thanks to our audio engineer, Stephen Crowley, for mixing this episode. This podcast expresses the views of Shane and I as the date indicated and are subject to change without notice. Elevate Capital Advisors has no duty or obligation to update information included. All information is for educational purposes only. Certain information concerning economic trends and performance is based on information from sources deemed to be reliable and has not been independently verified for accuracy. Wherever there exists potential for profit, there's also the risk of loss. This podcast may not be copied, reproduced, posted in whole or in part in any form without prior written consent from Elevate.